Yes, and as all parents of small children know, that once you have kids, you now become like a passenger in your own life. And this is my lovely family. This is my little guy. He's about to turn 3. That is my lovely wife. Like Brent was saying, what are we here for? We're really here to generate referrals. And what I do is kind of difficult sometimes to generate referrals because everybody understands that they need estate planning. I don't ever have to go out and convince someone that you need to get a will. The difficulty is convincing you to actually get the dadgum thing. And because everybody knows they need to do it, but they'll put it off for years. So what actually motivates somebody to do it is understanding that they have a unique risk. Because they think, oh, I'm okay. But you start talking through with people, they go, I didn't know that. That's usually a motivator that drives someone to actually pick up the phone and talk to an attorney. And so what I call is red flags. If you can convince somebody that they got a red flag in their estate plan, they'll usually move forward. And here's one of the big red flags that very few people know about, and that's large 401ks, 403bs, and IRAs are estate planning red flags. And we're going to get into why that is and what that does. And a lot of this stuff, I got to talk quick because I can't really explain it in 7 minutes and 10 seconds. But if you hold on to this piece, it is going to help you generate referrals in my direction. We're going to start off with, I'd like to meet Kevin. Kevin wasn't a client of mine. He was a father of a client of mine, but he was a real person. And these are the pertinent facts about him. Kevin died with a 401k rollover that was valued about $600,000. He had that 401k set as a beneficiary to a non-qualifying trust. And I'm not going to get into what it means to qualify or non-qualify. The key piece here for a non-qualifying trust is that if the trust is a beneficiary of your 401k, that means you're going to have to cash out the entire 401k in a relatively short period of time. Cashing out a 401k is a taxable event. So what we're doing here, because of the way he set this up, because of the way he did it, he put that in a way that it meant he had to take all the money out. Key piece of information here is there are 3 taxes that we're dealing with when we're talking about estate planning in general. You got your estate taxes that everybody's aware of over a certain value amount, would take 40%. You got your capital gains taxes, which is what you pay on real property, on a lot of investments and things like that. But another piece that most people aren't aware of is ordinary income tax, like earned income tax. Most people don't really think about that because you're saying, well, I'm dead. How am I earning money after I'm dead? How is that becoming an estate planning issue? And here it is. 401k, 403b, and IRA generate ordinary income, which makes this a very, very unique estate planning asset and creates a lot of unique issues. Basically, if you've got $50,000, if you do that during your lifetime, if you've got $50,000 and you take out $20,000, if you earn $50,000 and you take out $20,000 from your 401k, you pay taxes on $70,000 because if you earn the full 70. It doesn't matter if you have a gold-backed IRA or a 401k that's invested in mutual funds, which generally are capital assets. People say, no, it was a mutual fund. Doesn't matter. If it was inside your 401k, it's generating ordinary income. And so what does that do from an estate planning sense? It puts you on the ordinary income tax scale. Now this is an individual's ordinary income tax scale for 2018. I want to point to this piece right here, because this is, if you claim $600,000 in a year, this is what you're going to be taxed if it is taxed to you individually. If you do this to a trust, and again, what did Kevin do? He put the money inside a trust, a non-qualifying trust, which means the income was captured on his trust tax return. All right, remember this. Now look at this. Do you see the difference? Everything over $12,500 is taxed at the top income tax rate. Again, let's compare the two. $600,000 is where you hit top tax income. $12,500. So you're starting to see what happened to Kevin. He paid a lot more ordinary income tax than he had to. We can kind of compare that real quick. And these are basically the comparison of the two. If the only thing that was different in what Kevin did was instead of putting it in the trust, which knocked him for about, actually it was a little higher. These are the current numbers of what it would do this year. Kevin did this under the old tax system, which actually had him at 39.6%, not 37%. So his was actually a little higher. But if you did that this year, one difference being give it to an individual is taxed for it instead of a non-qualifying trust, that'd save you $60,000 in taxes. This is taxes saved. This is excess tax paid because it was taxed to a trust. Now, is there any way to fix this? Absolutely. I wouldn't be talking about this if there wasn't. The standalone retirement trust, and this is something, and another thing I need to point out is Kevin went to an attorney. Kevin didn't LegalZoom this. Kevin went to an attorney who either didn't ask or didn't know to ask, about these issues, and an attorney told him to do it this way. So just because you're working with an attorney doesn't mean that you've hit all your pieces. What a standalone retirement trust does is, the first thing it does is it's drafted to be a qualifying trust, which means that I can leave the money inside the 401k and I only have to take it out. I don't have to take it out just because I've named a trust as the beneficiary. That creates a huge benefit because I'm able to parcel that money out. Somebody has to pay taxes on this, but I can parcel that money out over years or decades. And I mean, you don't have to, everyone understands that if I take $600,000 in 1 year as opposed to $30,000 a year for 20 years, I'm going to pay more taxes if I do it all in 1 year. So that's what this eliminates. And this piece right here, because of the way it's set, it's actually taxed on the individual tax return, not on the trust tax rate. So when we're looking at, we're taxed on this scale instead of this scale, which drastically lowers the total amount of taxes that get paid. And finally, is you get all the benefit of a trust. You can still have a trustee that's set in place, that's managing the assets for your irresponsible kids. So we can separate control and benefit, which is the reason why you want a trust in the first place. I understand that I haven't explained all these numbers because it just isn't going to happen in the time frame that we have. But but this is the big takeaway. Is again, these are what we compared before. This is just going if we do all in 1 year compared to a non-qualifying trust, or all in 1 year for an individual tax return. If we use a standalone retirement trust, these are the taxes you're paid, and it is taxed based on your AGI because again, it's increasing the amount of money you earned in a year. But if you've got a beneficiary who's earning $120,000 a year, and we tack onto it $30,000 a year over 20 years, as opposed to in 1 year, the total amount of tax that they'll pay on that trust, on the 401k, is $132,000. If we lower that to $50,000 a year, if that's what they earn every year, then the total tax paid is $72,000. Again, and that's off of a $600,000 IRA. This all gets much more damaging the larger the IRA is. And again, this is the majority of income tax payers are somewhere in between this bracket. So the total amount of tax savings is going to be somewhere in between $88,000 and $148,000 saved on a $600,000 IRA as compared to just putting it in a non-qualifying trust. And again, I see this all the time. One of the things I do for a lot of the financial advisors I work with is just come behind other attorneys and fix this because people just aren't asking the right questions. I know this was quick and I know it's confusing, but again, 401ks, non-qualifying trust, red flag, the end.